Hello and welcome. I'm Jonathan Beale, and this is the ASB Investment Podcast, a show that keeps you up to date on the market and helps you make smart choices with your investments. The New Zealand and US elections are fast approaching, so today I'm chatting to Chris-Tennent about what we could expect from the market over the next 2 months. We also talk about the record highs of the share market, negative rates, and what the Treasury's pre-election economic update means for the economy. These are entirely our own views. It's not investment advice, but we know plenty of experts at ASB that'll be happy to chat if you need. Morning, Christopher. Good to talk to you again on this fine-ish day. And we're still at home. We're not back in the office quite yet, but how things have been with you over the last couple of weeks?
Oh, not too bad. Yeah, I'm still at home today, and but I have been venturing out a bit. I bravely went to Queen Street during the week for a face-to-face client meeting, and I must say it was quite stimulating to be talking to an audience of people, even if it was a bit small and distanced. But I was also amazed at just how quiet the CBD was. There's a lot of people that are still working from home, and I guess the Harbour Bridge compounds that. So it doesn't feel like going back to too relaxed yet. It sort of still feels like 2.5 to me, alert level.
Yeah, I was lucky enough to go up to Russell and saw some clients up there in the Duke of Marlborough Hotel, and it was quite weird because one of the barmaids sort of asked me where I was from, and I sort of apologetically said I'm from Auckland, but don't tell anybody. Just didn't want to know that you were sort of out of area. But there were a lot of Aucklanders in Russell. It's quite people getting away and doing sort of road trips around Northland, which is nice, trying to stimulate the economy and see the beautiful North. Kerry and buy some chocolate. It was cool. But we're still sort of bumbling along a little bit. I think you see what's going on around the world. We seem to be in a much better position than some other countries, particularly like UK, that seems to be going backwards at a fast rate of knots, doesn't it?
That's right, and I think there's so much debate about who's on the right path, and we'll only know at the end of it whether some of these measures were too draconian or unnecessary or exactly the right thing to do. But it is good to see people getting out and about, and I know that the businesses like Air New Zealand will be really appreciating people being able to travel again. But it's still pretty complex, and things are still getting cancelled. A bunch of sports events I've seen are open to everyone but Aucklanders and this sort of thing. So it's going to be a complex few months while we deal with these cases in Auckland, but it still seems very contained compared to what we're seeing offshore. And my brother over in Victoria, they're still very, very locked down, and your family in the UK are probably feeling the same, back to being locked down.
Yeah. My dad's in South Wales in Bridgend, which was making some of the news on the BBC website. How they're gone into lockdown, but he's pretty good actually. He's 80 this year, and he's a busy day is going to Tesco's and queuing up there. But he wears his mask and he social distances, and he sort of keeps himself to himself. So he doesn't seem to be going to lots of late night pubs and nightclubs. So I think he'll be fine. But
that's good.
And unless he changes his way when he hits 80. But yeah, it's interesting because we've had a bit of data recently out from the Treasury about sort of GDP growth or lack of growth, and the figures were pretty poor, but people seem to be sort of almost buoyed by the sort of the figure, which seems a bit odd when you're going backwards. Do you want to give a bit more colour on actually what the Treasury were telling us?
Yeah, so we got the pre-election economic and fiscal update from Treasury, and in the same week we got the GDP or gross domestic product data. So it does show how we're tracking, and I guess it feels funny to say, oh, it wasn't too bad when it was the biggest economic contraction by far for the quarter. What we were encouraged by is it wasn't as bad as we thought it could be when we were thinking about things in March, about how much the economy could contract due to the lockdown. And the outlook for the government, although there's still masses of debt on the horizon as we fill in this pothole, was actually a bit better than before too. And excuse me, this is all to do with how we're emerging from those really strict lockdowns, the 4s and 3s, quicker than we initially thought. And we're actually, there's signs that there's quite a lot of activity that's still able to take place. And this alert level 2 and 1 is definitely the place that we want to stay in, because most activity can take place. But it's still tough, and of course the missing bit is still tourism there. But overall, yeah, we were reasonably encouraged by what we saw within those data releases and economic insights. Even though it was still a terrible quarter, and there's still an awful long way to go.
And do you think we're getting better and businesses are getting better at coping with these lockdown levels and being a bit more innovative in how they do things?
I think so. I think there's things from a personal level. I think the Tracer app is pretty easy to use, and people can go in and out of shops and do a reasonable amount of stuff at these levels, and things like restaurants, I know from the local ones around me, are pretty organised at trying to get as many customers through as they safely can, and so it does feel like this is the new way in my neck of the woods. And on that vein, when I walk down the main street of my little town, it feels quite normal. But I contrast that with going into the CBD, and there's still a lot of people missing there. And those businesses, the service industries, the cafes and things, and some of the towns, which have just got so much less foot traffic, will still be hurting. And but I think businesses are on the whole getting better, and people are getting out and about a lot more now when they can. So yeah, that's a big help.
I went into the new Park Hyatt down opposite the ASB last week. They've been building it for a while. It's a beautiful hotel, and really nicely done. I just went into the cafe there to try out their pain au chocolat, which I can highly recommend. But I was talking to one of the ladies at reception about how open the hotel is, and it's sort of 7 floors. They've opened 1 floor for people to stay, which is quite incredible. There can't be many hotels are open around the world with that much, that luxury, and they only open 1 floor because that's all they can fill. And it's just a really good example, I think, of how the lack of people coming into New Zealand is really going to affect the tourism industry, hotels like that, people who work there. It's just a snowball effect, isn't it?
That's right, and the news over the last month or two on the vaccine development's been on the whole encouraging, but it still feels a long way off until businesses like that are going to get the tourism inflow to really push things along. And the other thing that's really big for Auckland hotels is domestic tourism, and people coming to Auckland for the weekend to watch a concert or see a big sport event. And so of course that's not happening, and so that's another hole in the demand for places like that. So that's where the rubber hits the road, or the real pain point, I think, for the economy, is those businesses that just aren't seeing the volumes, and there's still good health reasons why they won't see them see volumes of customers for a while yet. It's going to be tough, and that's one of the things that I keep thinking in my forecasts is, although there's some encouraging data and some encouraging activity, and we've got this idea that the economy gets back to running at 95% or more, It's not evenly dispersed. There's some businesses, and that hotel's a good example. They're going to be idling at about 20% capacity for quite a while, while there's others like the supermarket that are probably going to be running at about 110% capacity. So it's very patchy and impacting different businesses in different ways, and that's going to continue, I think.
Yeah, it's funny. I finally succumbed to bought myself a new television last week at Noel Leeming, and I was asking the guy about how busy they were, and he goes that like, we're so busy. Like the problem we've got at the moment is stock. It's just like it's selling fast and getting new TVs into the country. It's just like people seem to have if they're not spending it on overseas travel and big holidays, they're sort of buying these sort of I don't know if television's a luxury item, but probably is. Yeah, and it's just really really fascinating about how busy they are, and that people are sort of pivoting to where they're spending their money now. But, it's a very different world, isn't it? Now, one of the things I wanted to spend a bit of time on, Chris, and we've talked about this over and over, and every time we talk about it, it seems to be getting closer and closer. And actually, I think it might be here already. Is this concept of negative rates? So, do you want to sort of you've talked about? I think if we go back a while, we'll probably see some negative rates by 2021. But I think we've already sort of started, and we to see some negative rates in government bonds here in New Zealand.
Yep, this was this was one of those things where I had to recheck my computer screen. So the demand for government bonds has got to the level where the yields on 3 or 4 of the issues have actually gone negative. So the government bonds always pay out a coupon of interest, and so the negative yield aspect is if you were to buy a 5-year government bond now, and it had a face value of $10,000 that you're going to get back in 5 years and a few coupons along the way, you'd be paying an awful lot more for that to buy it. And in fact, you pay more to buy it than you'll get back in terms of cash flows, and that's where this negative yield comes out of. People rightly say, well, who on earth would pay that amount of money for a government bond? And of course, the answer is, well, the Reserve Bank is one of them, because the Reserve Bank is buying about $1 billion of government bonds each week, and that's what's driving these yields down so low, and in fact pushing the prices so high on the bonds that they're going into negative territory. So that's all happened over the course of early September, and the Reserve Bank's not backing away from this. They've just had a meeting. They're happy with the size of their asset purchase program and the pace of their purchases. So they're going to keep that pressure on government bond yields. And the other thing that they're getting ready for is a negative official cash rate. We think that'll happen next year, and also getting ready for funding facilities for lower rates. So in the case of the official cash rate, that's an overnight rate. Banks can't fund at an overnight rate. We're trying to fund 5-year mortgages and business loans, etc. But we think the Reserve Bank is almost ready to put in a term funding facility, so a longer term funding facility like we see in Australia, and that will drive interest rates down even more too. So that's where we think the downward pressure comes on mortgage rates over the coming 6 months, and so everything's sort of panning out the way we thought it would, but some of these things are happening a little bit quicker, including that dip into negative territory for government bonds. It's just fascinating to see these things that we watched it happen in places like Japan, and I certainly thought they'd never happen here, but here we are.
Wow. And as an investor who's holding sort of in a portfolio now that's got government bonds or corporate bonds, what are the implications of what's going on to their portfolios?
Well, this is good news for a long-term investor that's been holding those bonds, because they bought them at a set price. The Reserve Bank's happy to pay a higher price for them now, and that's what's driving these yields lower. So the capital value of an investor's bonds has gone up over this period while all this has been going on. So bond portfolio returns have been pretty strong over the past 12 months. The problem that we've got, though, is in the future, these incredibly low yields are going to be a constraint on what we can generate in terms of income. On the flip side of it, it's a great environment for growth assets if you've got very steady, low borrowing costs. So the growth parts of portfolios are where we'd expect to benefit over the long run, but it's been the bond part of the portfolio that's benefited from this big change in yield over the past 12 months. So for investors, it's actually not been despite the big upheaval we had in March, the 12-month period to the end of September's should look pretty reasonable, and bond performance should look pretty good and within portfolios because of the central bank action. So more evidence that we always plug along is why we run these diversified portfolios. It's really interesting where the performance comes from each quarter, and bonds have been a big driver.
Yeah, and so income's going to be probably the sort of the challenge, isn't it, for investors through the bond market? But as you say, the capital value appreciating is sort of it's almost like sort of flipped over, isn't it? Like you're getting something that you don't probably think that you're going to get when you invest in a bond, but I suppose the demand is so high at the moment; it's just driving prices up, isn't it? And the capital appreciation is great for customers in a diversified portfolio.
Oh, it's bizarre in New Zealand that we look at the shares to drive some income because New Zealand shares on the whole pay those decent dividends, and the bonds so far have been driving the capital growth. Where it all ends up when interest rates fall down to zero. If we look in Japan, they can stay at these levels for very long periods of time. Japan's been in and out of this negative or zero interest rate environment for coming up for 30 years now. Hopefully we're not there for 30 years, but it's certainly interesting times, and the negative yields have happened a little bit quicker on those bonds than I thought. But it's understandable when we see the pace of purchases. So that's happened in Europe and Japan, but our rates are lower than the US bond market now, lower than the Australian bond market, and that doesn't happen very often. So the other thing which is surprising is that the currency is still pretty strong. You'd think with some of this stuff happening we'd have a much weaker currency, but we don't, and the Reserve Bank's still factoring in that the currency will hold around these sorts of levels, so it's not upsetting them. But it might be a surprise to people that the currency is not weaker than it is, given the drastic drop in interest rates here.
And we're also seeing you mentioned share markets, but share markets in August had another cracking month, and just keep on trucking, isn't it? It's just it's incredible, really, when you think about what's going on around the world. But share markets continue to head north.
Oh, August was a really, really good month, and we've pulled back in September from some of those August highs. Depending on which market you're looking at, they sort of gained 5% or more in August, and then gave it back in September. But markets are still up just so much compared to March, and have exceeded the record highs that they were setting in February at the start of this year, and are hovering around those sorts of levels now. It's just been amazing performance, and really an endorsement that share market investors believe that the big spending of governments, the incredibly low interest rates are going to work and be around for quite a while, and the share markets are the place to have your money. I think we've seen some of these wobbles in September are caused by the usual dithering we've got used to in American politics of the trying to get the next fiscal support package through, the elections on the horizon in the States. We're probably going to see bouts of volatility. So the strong August filled with optimism, the slightly more conservative September doesn't surprise me too much, and we could have a couple of more months of that, given that we've got the US election coming up in November. I don't expect it to be pretty.
Yeah, and we'll move on to that, but just on the share market, I suppose it goes back to that, and you talk about it all the time, but but long term and your plan and what's your goal. But you can, you need to sort of step away from month on month, don't you, and go like August was really good. It's come back in September. It's definitely not a time to make any decisions. It's about sort of sticking with your plan, isn't it?
Oh, absolutely. And I had an interesting conversation with an investor yesterday, and they were wanting to make some changes. And one of their frustrations was they said, I just want to be able to see my balance each day, and they couldn't do that with the way that they were getting their reports. And of course, we can do that on their on our app. And in the back of my mind, I was thinking, I actually don't know whether you want to be able to see your investment every day, because it can drive you a little bit nuts. And looking at it bouncing up and down, and August and September have been case in point of that, where there's been some cracking days and some weekdays. But avoiding that noise and sticking to the long-term plan. I think when people look back on this past year, they'll be pleased that if that resonated with them and they just told themselves that on the bad days, because boy, we've had some ups and downs, but portfolios look quite good through it all at the moment.
Well, I actually looked at my KiwiSaver for the first time. I think it was last week. The first time I looked at that for actually before COVID, before the original lockdown. And the thing that spurred me to watch it was I to look at it because I got the annual report, just so I thought I'll have a look. And I was like, and I know I've got a rough idea, or well, pretty good idea on what's happened to it, but I just didn't feel the need to look at it through the whole thing, because I can't take it out, and I'm sort of, I like to think I've got, it's not 15, 14 years to retirement age. I still expect share markets in the next 15 years to go north. So it was good, but I got a pleasant surprise when I looked at it last week. I thought, well, that's done really well. So it's a real mindset thing, isn't it?
Yeah, oh, definitely. And I think the weird thing for me to think about, because I think about a similar sort of time frame until I can actually do withdraw and spend KiwiSaver, for example. And if my past 30 years of watching markets are anything to go by, I know in that 15 years there'll probably be a couple more events that really give me the willies, because that's just been the way it's gone, be it the Canterbury earthquakes, the global financial crisis, this pandemic. There'll be something, I don't know what it is, but there'll definitely be something to worry about between now and then, and so your set and forget strategy is certainly saves you a lot of worry if you can do that. But everyone's got their different ways of coping with the sort of volatility and news flow, and I think the next 6 months are going to be, the next 2 or 3 months are going to be interesting times with the amount of news flow we're going to get, be it elections, vaccines, trans-Tasman bubbles. They're all going to be things that are going to feed into our thinking about how businesses and portfolios perform.
And let's talk about Trump and the election, because I can't remember the word you used. It's going to be, I think, messy. It's definitely going to be messy. It's going to be like the reality show of all reality shows, isn't it? Really, but but in all seriousness, like if Trump doesn't get in, let's say, how's that going to affect, sort of, do you think, the economy and share markets? Because he's been, he'll say himself, he's been good for share markets, and it's all down to him. But
yeah,
is there a worry that it might sort of go the other way?
I think there's a couple of things that really stand out that have really helped drive the US share market in particular. One is, if you look at the growth of the US share market and the growth of the national debt in the States, they really go hand in hand. When a government's running a really big deficit, like Trump is, that's a lot of spending going into the economy, and it tends to end up supporting shares. And this would be the same here. If the government's spending, that means businesses are able to make money, or they're spending on putting money in people's pockets that they'll in turn spend. And so the scale of spending that's happened in the States, and the deficit that Trump's happy to run, has helped. The tax cuts, which are part of that deficit too, also support the share markets. Now, the counter to that would be, hey, if Biden gets back in and he's really draconian and he doesn't spend and he reverses all of those tax cuts, will that be negative for shares? And I don't think they're about to radically change the course of things in the States, but that'll be the message that I'm sure Trump tries to portray. The share market did well under Obama. It's done well under Democrats in the past. So just the fact that you have a changing the guard doesn't need to be bad news for the share market. And likewise here, as we've seen, you could have had all sorts of right-wing theories about how bad Labor is for business. But that didn't translate to share market performance, given that we've set fresh record highs under a Labor government. Here we're lucky that there's nothing too radically changed in the landscape with whichever main party we get. They're fairly central parties, and there is a bit more at stake in the States. But I think over the long term, we'll see some volatility around the election. But over the long term, the fate of the US share market will be a function of global growth and good company management, and that will continue regardless of who's the president.
And what did you think of the debate here we saw I think beginning of the week with Jacinta and Judith?
Yeah, well, we're in that sort of space where the National Party have really got to generate some headlines and some news. I guess my disappointment from both parties is we've still got to get a long-term plan out of how to transition from this current environment where the government's subsidising a lot of salaries still. The borders aren't open to, well, what does the economy look like over the next 12 months? How do we manage some of these issues? So it's kind of fine to talk about big infrastructure projects and a second harbour crossing and all of that sort of thing. But the next year or two, the plan for that is the important bit. And to a certain extent, they've got to make it up as they go along. As we learn more about managing this new life we've got in with this pandemic. But I'm not sort of super satisfied with all the answers I'm seeing from either party yet. But hey, we've got a few more weeks of it, and then hopefully we can just get on with it. And it's always interesting, this last little run into the election, because I've seen so many times where it looks pretty set, and it gets much, much tighter as you get into those last week or two. So, it's really important, the messages that both political parties and both leaders send out over the next couple of weeks, because it will change the mix, that's for sure.
Definitely. And I'm with you. I'm a bit disappointed in both, because you sort of say you've got a plan, but just saying I have a plan is, and not giving any detail is just sort of a bit nonsense to me. It's a bit like, if you think about sort of financial planning, and you need to have a plan, but it needs to be a detailed plan. You need to think about, like, when am I going to retire? What sort of income am I going to have? Where am I going to go? What am I going to spend my money on? Like where's all the detail? That seems to be missing for me. I thought, it was good. It was sort of good TV, wasn't it? Judith Collins was pulling some pretty cool faces when Jacinta was talking. So there was, it's good TV. But
yeah,
I just think they both need to give a bit more detail, don't you? Especially in this time where we're, recession, people are looking for guidance and a way out. I just don't think you can pitch aspirational things to people. I think people want a bit more detail, don't you?
Yeah, and this is one of the bits where I quite like my job, where we can look at New Zealand, how it's going, and I don't like everything I see in politics here, but looking at the actual economic performance here and some of the decisions that we're making, and then trying to forecast how that's going to translate into growth. It's quite good when you look at those numbers and I think, okay, we're broadly on the right track compared to some other places around the world. So, and our politicians are reasonably centralist. You can tell whether it's genuine or not. You're always going to get this image that there's no love lost between the two political leaders. That's part of the game. But at least they haven't resorted to childish name calling and things like that. It's
exactly.
I quite like living in New Zealand now, even if I don't like everything about the 2020.
Exactly. We've got a lot to be thankful for. Hey, Chris, I'll probably call it a halt there. So, hey, as always, thank you very much. Really fascinating about the negative rates and you sort of explaining that. And also, it just shows how good you and the economics team are about sort of predicting what's going to happen in the future and being able to clarify it to our customers. So I really appreciate that, and our customers do as well. So keep safe, and hopefully we'll be able to raise a beer in level 1 shortly with lots of people around us. So
sounds
take
good
care.
to me.
Speak to you soon.
Okay, bye-bye.
All right. Cheerio. Bye. Thanks for joining us today on the ASB Investment Podcast. If you have any thoughts on today's episode, or if there's anything you'd like us to discuss on future shows, please fire your suggestions through to podcasts@asb.co.nz.